Well, I guess we are live. Hello,
Awesome.
everyone, and thank you for joining this first debate organized by Aave. My name is Marc Zeller, and I'm glad to host Kane Warwick, the CEO of Synthetix.io, and Art Lambert, the co-founder of UMA protocol. Our main topic today will be around synthetic assets and obviously decentralized finance. Can you both present yourself and your project, like a brief presentation, and let's start with Art.
Sure. Thanks, Mark. Thanks for having us, and it's going to be fun chatting with Kane. So yeah, I'm the co-founder of UMA. 2 seconds of background are that I studied computer science, but then worked as a bond trader at Goldman Sachs for 8 years through the financial crisis, where I actually sat next to my co-founder, Allison. And then I started a fintech business and then got back into the crypto stuff. But that background, less interesting than what we're doing today. So the secret master plan for UMA is that we're actually building infrastructure to create what we're calling priceless contracts. So this is a design pattern for how we can build DeFi contracts that minimize Oracle usage to avoid many of the security and scalability issues that have plagued decentralized finance. What we're starting with is our first templates. Our focus for the foreseeable future is on synthetic assets. So these are contracts that can track anything with a price. And we've got a different approach than what Kane and the Synthetix team are doing.
Great. And you, Kane, can you present Synthetix to the audience?
For sure, yeah. So I'm Kane, the founder of Synthetix. As Hart said, we're both building synthetic asset protocols, but I think they're kind of taking different paths. So we've kind of taken this approach of bringing oracles on chain to allow people to get exposure to a range of different assets, right? The prices of different assets. So at the moment, we've got things like gold, Bitcoin, we've got silver, we're about to launch oil. We also have some equities indexes, so like the Nikkei, FTSE are now live. So essentially, large cap, large liquidity assets that have very liquid spot markets or very liquid futures markets that we can go and take an oracle and assign a price to it and bring that oracle on chain and publish the price onto the Ethereum chain, and then allow people to have a tokenized representation of that they can hold. And there's some other weird stuff, behind all of that, but that's kind of the basic pattern that we're building.
What would be a simple definition for those who don't have it yet to a synthetic asset? A tokenization of a real-world asset through a derivative?
Yeah, I mean, there's different ways, I guess, that you can approach it, right? In our case, we just have a token that you hold. So, for example, our SXAU token, which is a gold ounce, right? It's like holding, an ounce of gold, right? It's essentially just a exposure to the price of gold, via this oracle mechanism. So, if you prefer to hold gold and you don't need it custodied and you just want the exposure to gold and you don't want the magical properties of holding a bar of gold in your hands, then it's a good way of getting that price exposure.
I think that's pretty interesting because you're just talking about gold, and we know that most trading that are happening on that asset is actually about paper gold, what we call paper gold. So actually representation of the physical assets, because obviously holding golds, the physical one comes with a lot of issue, and most people just want an exposition to the asset price. So synthetic assets, would you say that it's a way to have a broader audience to invest or be exposed on the price of many assets?
So I think both Hart and I have a similar view on this, right? That it's like if you take these different synthetic assets and put them on Ethereum, anyone with an internet connection can access them, right? You don't need a brokerage account or what have you. So. Hart, sorry, did you were going to say something?
No, I think you froze for a second on my side, but actually,
Yeah,
Kane, what I would add to that, it's worth going like a little bit deeper. So let's just take gold is a good example, but it could also be a share of something like S&P 500, let's pick a particular company for a second. That thing you can only buy today if you have access to the legal mechanisms and the way to custody that piece of paper. And not everybody has that, or a lot of people don't. So, what's very kind of cool and compelling, and where Kane and I do share a very similar philosophy, is that if you can actually have a synthetic representation, so an ERC20, or let's say an ERC20 representation of whatever this asset is, you can buy that anywhere that you have access to an internet connection. You don't have to have access to, say, a custody account at a US brokerage, or access to a paper trading account where you can buy paper gold. You actually can have the risk profile of this thing. And that is a pretty powerful or pretty cool concept. One thing I like to point to is if you think of financial markets today, they are not global in nature. It's like what you can buy as an American with access to like the American financial market is one set of things. What you can buy in Australia is a different set of things. What you can buy in Portugal is a different set of things. They're all siloed. And the reason why they're siloed is the ultimate enforcement mechanism for all of these financial products is really rooted, I would argue, in their like local legal infrastructure. And what this synthetic idea is really doing is unlocking that. And we're creating a different infrastructure, a different means to enforce financial contracts, one that is fundamentally global and like internet native at its core.
I completely agree with that. And when you go even deeper, usually like investors, they are tax implication or tax shelter implication. So for example, everybody can hear it, I'm French. As a French, if I invest in French stock markets, I will pay a lot less tax than if I invest in American companies. And maybe synthetic assets, as you said, allows us to invest or at least be exposed to the price variation of this kind of assets. And one of the great example of that is live right now on Synthetix networks. If I want to be exposed to the Nikkei, I just have to buy the S Nikkei index directly on your platform. And that's not something I can do. Or if I can do it as a regular investor, I will pay a lot of fees, have a lot of tax implication issues, and also pay a lot of commission to a centralized broker. And also one of the good things about synthetic asset is that you can create brand new assets. And that's one of the very interesting things that was launched by UMA recently on mainnet is the LBTC synthetic asset that is tracking the fluctuation between the ETH and BTC, Ethereum and Bitcoin pair without having to have exposure on both assets as you enter your position in DAI, which is the stablecoin of MakerDAO based on USD. Can you present, Art, this new kind of assets?
Yeah, totally. So it's worth framing like what we were doing here. So we have created this new infrastructure of what we're calling like a priceless contract, one that doesn't need to use an oracle or doesn't need any oracle prices in the optimistic case. And we wanted to test this infrastructure, really this is our community, wanted to test this infrastructure with a product that is quite experimental. And wasn't meant to be, it's not meant to be a mainstream product. It's actually by design meant to be a little bit weird, a little bit DeFi native. And so we picked this ETH-BTC token, which is, when you actually look at the financial engineering behind it, it's a pretty interesting asset where, again, you are betting on this price ratio of ETH versus Bitcoin without owning any Ethereum or any Bitcoin. And I think what this shows is, so far in the life of this experiment, we haven't had to have any oracle calls whatsoever. So we are showing that this infrastructure of being able to have an asset do what it's supposed to do, have a contract do what it's supposed to do without requiring an oracle, that's working, which is pretty cool. And it also highlights how extensible and how open the design space is for this type of contract that we're creating, where you really can take any index and create an asset that tracks that index.
What is really interesting on your approach, and I think it's a question for you both, is that us at Aave and Synthetix Network, we are using on-chain Oracle with Chainlink, and that's the way we get price feed on-chain for the assets we list or represent. And you take a completely different approach with the priceless assets. What do you think of on-chain oracles and what led to this decision?
Yeah, so no, I want to, on-chain oracles, there's very much a use case, and like there's a space where that is the right call or the right design. But there's trade-offs here. So on-chain oracles, in my understanding of both Synthetix and Aave, they are critical. If they go wrong, like very bad things happen, and like a lot of money can get lost, and it can be a big mess. That's sort of one problem. The other issue here is that you need an on-chain oracle for every asset you want to support, which means pushing transaction fees on chain. And so there's like you can't do long tail things, at least as easily, by having that type of oracle. But there's it's very easy to grok. There's a price that I get on a blockchain. What our kind of philosophy or thesis here is to actually design contracts that act more optimistically, where we don't need to use an oracle unless we get to a bad outcome. So the idea here, the analogy I like to use to explain this might be like us writing a legal contract. So say Kane and I write a legal agreement for some contract. It could be the payout of a financial bet, whatever it is. Our intention when we write that is that we don't litigate it. We don't go to court and sue each other. Our intention is that we both follow the terms of the contract, and then when it's done, we're happy and we move on and everything is good. That's effectively the design pattern we're using in our approach to DeFi, where optimistically, if everybody does what they say they're going to do, there is no need to call an oracle. Instead, an oracle is kind of like suing somebody. You only use it when there is a dispute that you need to have resolved that the two counterparties can't agree to. And so basically our general thesis here is like the safest way to write DeFi contracts is to minimize oracle usage. And this optimistic design pattern lets us do that.
What do you think of that, King?
I mean, look, you know, as I said, I think the UMA approach to this is very novel, right? There aren't too many examples of this. I mean, maybe the closest thing is like Augur, right? Where you've got these like multiple layers of disputes, right? Like you assume that there's going to be something that goes well, and then if it doesn't go well, and the result that everyone knows is true doesn't happen, or knows is false doesn't happen, or whatever, you know, I guess the interesting thing that we've seen with things like Augur over time is that when you have these constraints that potentially add friction, right? Or add complexity to the implementation for a user to kind of understand how the system works, it can be a large barrier to entry, right? But the flip side is that you get this kind of superpower, which is the thing that, you know, for me excites me about UMA, is that you can do the long tail, right? You can do weird stuff that like Synthetix will never be able to do. We need a deeply liquid market somewhere for us to be able to kind of piggyback on, right? And pull that data. And so the idea that you can have a much wider range of assets is really cool, right? And Harden and I have even talked about this and said, you know, it is possible maybe that you can kind of combine these two approaches and like bring some liquidity to these small markets and build them up. And, you know, I think we're seeing a lot of experimentation with that, with things like Balancer and Curve and stuff. And so, you know, I do think that the ability to have this wide range is very powerful. But for the average user, you know, I mean, even if you look at centralized services like FTX or whatever, right? They do all kinds of weird experiments all the time and no one uses them, right? And they're a centralized service that can just do whatever it wants, essentially, right? They can make a market on anything. It's centralized. They control the infrastructure, and yet people don't really use it that much, right? And so, you know, I guess for us, our view is let's go and make markets in the super liquid things, right? You know, large cap equities and you know, large indexes and things like that. And you know, we'll leave the kind of long tail stuff that we can't touch and accept that that's one of the trade-offs of this approach. I mean, there's other trade-offs as well, right? Like oracles, you know, as Hart pointed out, are super risky, right? You need to get them right all the time. And if something goes wrong, then, you know, it goes wrong in a very bad way. And that's just one of the trade-offs that we have in our system, right? And try and build as many kind of layers of protection around those oracles to prevent that from happening.
I think when we talk about oracles and price feeds, the most important point is the consequence. If we want the price feeds, it's because we want to know when the actual position is sufficiently collateralized or not, and what's lead to liquidation. The current industry standard is currently on over collateralization and liquidation bonus for liquidator. Synthetix launched with the actual higher collateralization factor of the DeFi ecosystem, which is, if I'm not wrong, just go down from 800% to 750, but do not enforce liquidation. Instead of penalizing the underwater position, you guys reward good behavior with SUSD and Synthetix distribution. On the other side, you guys at UMA, you use your native assets to solve dispute around liquidation. So we are here two models that are very interesting because they are not exactly the same as the industry standard that we can find on MakerDAO, on Aave, or on Compound. What lead to those design process? And can we start with you, Kane?
So actually, we just launched liquidations. Interestingly enough, right? It's a very soft liquidation process, right? Like there's a 2-week window. Last week, I think, or the week before. Yeah, like very, very recently. So no one's been liquidated yet, thankfully. So it's not something, you know, we still have a very high collateralization ratio to prevent that, you know, that being triggered. It's kind of a backstop mechanism. You know, the primary incentive is the loss of fees and the loss of you know, incentives if you deviate from the C ratio. So I think, you know, the decision for us and most of the design decisions that we've taken have been driven by this idea of, you know, trying to start off with something that is not viable and then bootstrap it to some level of viability. Right. So, you know, we started with something that is not a reasonable approach, right? Like using SNX, which is illiquid, had very little value. How do you start with that? Because our very strong belief is that in the long term, that is a very viable system, but in the short term, it's not, right? And I think that's, you know, the case for most startups, right? You do something that's not viable, and you know, you do things that don't scale, and you do weird things to kind of push it in the direction that you want and hope that you don't blow up before you get to that place that you're aiming to go. And so, you know, for us, not having liquidations was a way of kind of protecting the people who are providing collateral, because we needed to do everything we could to kind of accelerate the adoption of being a collateral provider in the network, right? Like as much as we could give the SNX holders, we were trying to give them, right? And that's worked, and we built it up to a point where the SNX holders are very happy. They're happy to provide collateral. They're happy with the trade-offs that exist in the system. Now we need to start, you know, paring that back a little bit and adding, you know, a little bit more structure and control, which is taking things away from them, right? But we need to do it slowly in a kind of sane way so that they don't all, you know, freak out and run away. So that's kind of the process that we've been working through.
Super interesting. And you, Art, I think you have a completely different model because you have only 120% T ratio. That's right?
Yeah, I mean, these are very different models. But first of all, a comment, like for Kane's approach, I find it very refreshing. Like it's very, it really is. It's a carrot versus stick approach where Kane, what I think I might form one way of kind of framing these different models is like the SNX approach, where there's no penalty for being liquidation until like today came, ignoring that detail for a second. It's just a carrot, right? It's just a carrot. You just keep trying to incentivize people for, hey, you should maintain your collateralization ratio of 70. You should. And it's worked so far, right? I think there's a very long, interesting debate about ways where maybe it doesn't work or where it gets scary. But like Kane said, you know, you're trying to make it more viable over time, and I think that's actually like a really fascinating kind of just mental model. Our approach for collateralization, I'd actually say, is very analogous to the Maker approach, except that we're doing it without an on-chain price feed. So Maker's approach, like ours, and unlike Synthetix, is a stick approach, carrot versus stick, where you drop below your collateralization ratio, you get hit, right, and you get immediately liquidated. Maker and Aave and Compound, most of the systems work that way by, again, having an on-chain price feed where anytime somebody drops below their liquidation requirement, you can only check it versus that on-chain price feed. So I'm a keeper bot or whatever, and I see, Marc, your position drop below, and I go and I take the on-chain price feed that's approved and say, hey, I race to liquidate you, and I get some reward. What we've done here by trying to get rid of this on-chain price feed is we say, hey, we're going to follow the exact same concept. It's still a stick approach, where when you drop below your collateralization ratio, we'll liquidate you. Except you, the keeper bot, you decide whether that position, you decide if Marc is below his liquidation ratio or not. You don't need any on-chain price. Use your own off-chain price feed. And what we then say is, like, you don't get your reward right away. You wait 2 hours in our current parameterization, in which someone could challenge you if they say what you liquidated. If they say your liquidation is wrong, they can challenge you, and then it goes to an oracle. But the idea of doing this is that we don't have to wait for an on-chain price whatsoever to decide when somebody's liquidated, which means we have much higher frequency price reporting. So in theory, we have like almost near time price reporting of the blockchain, because anyone can watch the price off chain. And the moment your position becomes under collateralized, they can liquidate you. What this lets us do is lower collateralization ratios through the system, because we have much shorter, we have no latency, we have no gap while we're waiting for a price to get pushed to chain. We literally can compress collateralization ratios quite a bit and allow for higher leverage things because of the speed, because we can operate at basically the speed of off-chain prices.
And just to be clear for the audience, the dispute resolution is reserved to the UMA token holders. That's right? That's
right. It's like shelling. Basically, the token holders then vote asynchronously. So it slows down the process. They vote and say, hey, was this dispute, was this liquidation valid or invalid? And to give them an example, just so sort of how this all works, if you think of like the Maker system, on a typical month, you know, they're probably, I think they have something about like 8,000 price pushes on chain, of which the vast majority of them don't get used for any liquidations. There's only like a couple hundred liquidations in a normal month. So you've got a lot of prices that are being pushed to chain that aren't getting used by, say, Maker. What we're saying, what we're saying is we're not going to push any prices to chain at all. We're not even going to push prices to chain when there's a liquidation. We only need a price when there's a disputed liquidation. So the theory behind this is that we could run something the scale of Maker's system with like 1 or 2 Oracle requests a month, which allows for a lot of scalability and allows for like a different design space for oracles.
That's actually super interesting. Like right now, like the main issue with Ethereum is that the gas prices are through the roof. Like so many things happen on layer 1, and for example, on Synthetix, every week you can claim some rewards if you are sufficiently collaterals on an app called Minter. But what an interesting phenomenon that we witness at Aave is that a lot of relatively small holders of SNX are actually depositing money into Aave in order to have maybe a bit lower interest rate or yield on their holdings, but not having to pay the actual transaction to claim their rewards. And we had some adaptation on the market, and it was pretty interesting from a financial perspective to see that borrowers are taking the opportunity to borrow more SNX in order to actually claim the reward themselves, because they have this economy of scale around the gas price. What do you think about layer 2 solution? Do you think that layer 2 will happen sooner than expected on DeFi due to high gas price?
I don't know. Unfortunately, I don't know that the pain of high gas prices can make us do it any faster. I think you know, the drive to kind of get it done as quickly as possible is already there, right? You know, even, I mean, maybe if like what it was like 200 or something like that, we'd all get together and like try and do something even faster. But I think there's just sort of a limiting factor. You know, with us, we're going with the Optimism team, and you know, I think they're working as hard as they can to get to mainnet as quick as possible, right? So, you know, high gas prices are painful, but maybe don't necessarily speed things up much more. But I mean, to your point, I think this is one of the most interesting things to me about the ecosystem as it stands now, and composability and the realness of it. Like, you're seeing these kind of emergent behaviors of people saying, okay, well, gas prices are too high, therefore, you know, if I've got 50 SNX, it's not worth me claiming, but I can put that SNX into Aave, and someone who already has SNX, where the marginal cost of their claim for that 50 SNX is zero, basically, right, can therefore borrow it from me, right? And the market's finding this equilibrium in terms of like how much yield they're paid, right, for these small borrowers putting into Aave, you know, at once, and then the large borrowers saying, small lenders putting it into Aave, and large borrowers coming in and, you know, fighting to get access to it. So it is super interesting, and you know, for me, the more of these little kind of micro markets that emerge, the more real DeFi kind of becomes, right? Like, we're really seeing that there are genuine kind of incentive alignments that you know, and micro markets that are emerging to deal with weird things that no one was expecting. We weren't expecting Gwei to be, you know, I just looked at it then, it's 25 is you know, safe standard, right? Like, we just didn't think that we're going to be sitting in an environment where it was just 25 forever, right? And like 15 was amazing. And so, you know, that definitely changes the behavior of users of these systems, I think, and makes it painful. But, you know, for us, as soon as we get on L2, we absolutely will be.
Yeah, because right now I think, would you agree both that those high gas prices are the main bottleneck of DeFi growth today? Because we are all contributing to a decentralized finance ecosystem that we want more transparent than the traditional finance, open to everyone with exactly the same rules to everyone. But right now on DeFi, if you don't have at least $1,000, is it really worth it?
Yeah.
I don't, so, okay, first of all, on the layer 2 question, I'd actually say, like, all the thinking behind this priceless design, behind everything I laid out, where we like minimize Oracle usage, that was all inspired by actually the Optimism team. They're in New York too, the same team Kane's working with, but they literally, like, layer 2 thinking is embedded in that, where we will try to write these contracts that don't require any transactions, or don't require, minimize the number of transactions that are required in the optimistic or happy path. And let's just use an Oracle in the exit game or in the unhappy path. So actually, like, got to give a lot of credit to the Optimism team, because there's, I think, a lot of this layer 2 thinking. It's just the right way to build these systems on a blockchain where the constraint is transactions. And so the whole system, I think, is going to evolve in a way where we minimize the number of transactions that happen on layer 1 systems, because that's like the right thing to do. And there's a bunch of paths to that. And everything Kane said about how quickly the market figures these things out and comes together based off incentives is, like, kind of amazing to see. So that's all really cool. But Mark, to your second question about, like, what is the major constraint? I mean, I think it's actually a much more basic question, what the major constraint is to DeFi. And that's just literally onboarding people into crypto, and having wallets that people use for crypto, and having people just have crypto in their hands. That to me is the major constraint. And perhaps we can't do that, or perhaps there's less of incentive to really rapidly onboard people while gas prices are so high. But I do still think, this is a bit of a tangent from what you're saying, I do still think that as an industry, we need to be asking ourselves more and more, how are we going to get people that aren't like hardcore DeFi nerds? How are we going to get those people onto our platforms and using this shit?
I think one of the really interesting thing that will help a lot on adoption and has helped a lot on adoption are actually the stablecoins. Because when you have something that looks like a lot of fiat currencies and behave the same way, it's much easier to implement and use it, for example, as a unit of account. And I think it's completely on topic. Would you guys agree that decentralized stablecoin like DAI, SUSD on Synthetix, or even the S-Euro are synthetic assets by nature?
Yeah, I think so. You know, I mean, they're part of our kind of stable of assets, right? So, you know, anything that is somehow constructed to track the price of something else, right? Like DAI is ETH mixed up, and you know, a USD stablecoin comes out on the other side, right? Which is pretty cool, right? So I think there's a whole bunch of different ways you can do this. But to your question about stablecoins and adoption, or even just DeFi generally, right? Like one of our engineers was talking, and he was saying, you know, he was at you know, a friend's place on the weekend and trying to explain one of the new DeFi things that had come out, right? And I said, you know, I think one of the pitfalls that we have, and one of the things that we do, which is maybe partially because we are all DeFi nerds and we want to explain how cool it is to people, is, you know, we go too deep, right? We start explaining like underlying mechanisms of things, right? And I was like, you know, if you tried to explain to someone how an operating system works, right, versus like just using an app, or like Uber, right? Like Uber is a great example. The amount of like engineering that goes into like the multiple layers of stuff to like make Uber work, right? If you are sitting there trying to explain Uber by like walking through the routing algorithm that like gets the car, like you've missed the point, right? Like Uber is, you open up a thing and you press a button and someone turns up and they take you somewhere, right? You hope, right? And I think that with DeFi, there's an opportunity for us to kind of describe it in a way that's much more kind of salient for a user, right? Like, what is the problem that it's solving for the user? And I don't think we do a good job of that. But to come back to your point about stablecoins, the fact that Bank Frick, who's a weird bank, to be fair, like in Liechtenstein, but like they're still a bank. They still have access to money. They've got databases that people, you know, they're a regulated bank. They accept that their database is money, right? And they can connect their proprietary money database to stablecoin rails via Ethereum. Like that's a like inflection point in my mind, right? Like when I saw that happen, I was super surprised by it, and I think it's amazing because it solves that last mile, right? You know, we've had Ripple and people like proposing these weird, convoluted, shitty solutions for like how banks can talk to each other for a long time, and all of a sudden, you know, we've just got USDC. And look, I don't love USDC, but like I love it a lot more than I used to. But like it, you know, it's a centralized solution. But if USDC becomes the rails on Ethereum, that is without a doubt, you know, the interbanking rails become like an Ethereum open thing that runs on USDC is like without a doubt a better result than I think anything I expected to see in the next like 5 to 10 years. So I think things like that will absolutely happen. And I think that it'll make it much easier for us to just say, it's just money. You just press a button and the money turns up in, you know, 15 seconds instead of 10 days, right? That it would take for, you know, a normal wire through like 3 different correspondent banks if you were sending money from Australia to Bank Frick, for example.
One of the very cool thing that happened also recently is the launch and the growth of Argent, the mobile wallet. And literally, I did the test with my own father, which is not very technical and not tech savvy. Well, I can say that anybody is 5 minutes away from using Aave or using Compound or probably, and I hope soon, invest in UMA protocol assets or invest in SDFi, for example, the synthetic asset on Synthetix with Argent, because they have Apple Pay and Google Pay integration, so you can buy a very small amount directly. There's no seed to handle directly. The UX is completely seamless. And I think that's a great pathway for adoption. And they had for the longest time the coverage of gas fee. Obviously, they had to turn that down because it's very costly right now to do that and pay the gas on behalf of their users. But some protocols are still incentivizing this action. And for example, if you use Aave on Argent or pull together on Argent, you don't have to pay the fee because we are paying the bills, basically. Do you think this kind of tools will be an easier pathway to your project directly than just having people with ledgers, hardware wallets hanging around?
Yeah, I mean, Argent's a beautiful product. I think we need more and more innovation on the wallet side. I think this does lead to adoption and does it's all very positive. And you know, when you look at like the DeFi space generally, the momentum in the space as a whole is pretty astounding right now. And like the amount of new shit that's happening, the amount of experiments that are being run is it's hard to keep up with, even for somebody that is like deep in it. There's a lot going on, and I think all this stuff it's snowballing. It really, like, I'm actually quite bullish on the space. It really does seem to be snowballing, where people are the experience is coming together. And Mark, you are right to go back to your earlier point, talking about constraints that might slow down that snowball. Gas fees, gas prices being one of them. I think those are things that we should be concerned about, but like the overall momentum of the space, it seems to have taken on a life of its own that right now at this moment feels a bit unstoppable. It does feel like the DeFi momentum is going to like keep going through this COVID thing, keep going through 2020 and kind of accelerate in the years to come.
Completely agree. One of the very cool things that is happening on Synthetix is that you can actually buy index or complete synthetic index. And one of the community favorites is SDFi, which is a basket of several currencies that reflect assets of the community, of project of this community. Do you have like on the roadmap new synthetic assets resembling SDFi and this kind of portfolios, I would say?
Yeah, so you know, I think it's worth kind of you know, caveating that with like, it's interesting to people, but it's not like there's a ton of activity on it, right? I think there's like 150 or maybe like 200 grand worth of open interest, right, on SDFi. And so, you know, I think we see a lot of these things and they're kind of proposed and, you know, they don't necessarily get a ton of traction. You know, but we see it as a potential kind of pathway to some level of interest, right? But you know, the reality is that the majority of the usage is still happening on BTC and the like large cap crypto tokens, right? That's still where the majority of trading happens, and the inverse tokens as well of those assets. So you know, while I do think that you know, being able to kind of tap into the weird, more exotic stuff, you know, people want SDFi too, right? Which is going to have a bunch more assets in there. You know, it doesn't have a massive amount of trading activity, and it doesn't necessarily have a massive amount of what I would call traction, right? Like, I think, you know, it's easy to propose these things and you know, kind of put them out there, but driving, you know, actual usage of them is still a ways away, right? And I think we need to bring more people in and you know, expand the DeFi bubble, because even within Ethereum, there's a DeFi bubble, right? There's an Ethereum bubble that's within the crypto bubble, and then there's a DeFi bubble, and like there's 5,000 of us within this DeFi bubble. Like, it's a very small bubble, right? So we need to kind of bridge the gap to the wider Ethereum community. And then I think there's this huge crypto bubble comparatively, right? It's like 2 orders of magnitude larger that is still not aware of Aave and UMA and Synthetix, right? Like, it's just like that, maybe they've heard of like 1 or 2 protocols on Ethereum, but like not, they might have heard of Maker, right? If we're lucky. But I think that there's a whole range of things that people still are not aware of yet. So we got a lot of work to do, and there's cool stuff happening, but it's still very experimental, and we need to work on adoption.
And if I'm not wrong, if somebody from the Synthetix community wants to add a new asset, you have a specific governance process for that, the SIP. Can you explain how it works to the audience?
Yeah, so it's modeled off the EIP process, right? Which is modeled off like the Python process, which is modeled, so like it's this like chain of open source governance processes, I guess. So, the process is open in the sense that anyone can turn up and say, we would like to change this thing. And, it's not token governance in the way that, like, say, Maker has, right? Where, someone has to have a certain amount of tokens to be able to do something. So it's a process that's been working fairly well. But there's more to it. If you say, hey, we want to have, asset X, right? It still needs to be feasible. So there are still constraints. We can't do something like, the shitcoin, the shit token index that Hart did for SF, right? Where like you're tracking some weird number. Like, we just don't have the ability to do that, right? So there's cool stuff that that we can't tap into, I guess. But within the constraints of the actual system itself, anyone can propose something.
And how does the governance work on UMA protocol? We talked a bit earlier that the UMA tokens is at the center of the dispute resolution system, but I think it's also a governance token, right?
Yeah, the cool thing is the dispute resolution and the governance are kind of one and the same thing. They're just votes either way. And yeah, we've created, just like Kane and a lot of other, I think all the leading projects in DeFi and on Ethereum have followed the EIP process, which followed the Python process. But we have, we call them UMIPs, UMA improvement proposals. And the cool thing about our thing is cool / maybe slightly scary, is that anyone can propose one of these proposals. It gets debated. If there is a quorum of more than 5% of token holders that support it, it has to go to vote. Like, it will go to a token holder vote and it will get approved, or not, depending on what the broader token holders say. So we're using effectively the same dispute resolution process as our governance process to approve new asset types or new contract types or changing system parameters. And this does mean that we have a very, again, this is very early days. We've only used this for one asset, which is this ETH BTC test token, that experiment that we ran. But we have a very open process where anyone can come around and ask to add a new asset type. And if it gets approved, they would be able to use that new asset type to create a synthetic token. So yeah, it's kind of cool. And these governance experiments are happening in parallel with all this other DeFi stuff. I did, though, Mark, think it's interesting, going back to Kane's point about talking about where we think usage is coming from. And I think Kane very accurately said, synthetic assets today, the demand lies with stablecoins and like truly crypto related things like synthetic Bitcoin on Ethereum, or maybe like some inverse Ethereum tokens or stuff like that. And I think it is worth us pointing out that, that's again, because I agree with Kane, it's a very small number of DeFi nerds who primarily are looking to trade crypto. And frankly, I'm curious to get both your thoughts on how we think that's going to evolve, what the coming years are going to look like. Are people going to stick with really trading like fat head crypto products and stable coins, or any like theories on how we evolve into building demand for other products?
I think one of the main things that should evolve when we get a broader audience in DeFi is that actually when we look at all the protocols, there is almost no demand for short, like actually leveraging on the decline of the valuation of crypto assets. And I think Synthetix is probably one of the only platform where we can see that the token, which is the inverted synthetic asset tokens that are betting or price decrease valuation of the underlying assets, is the only one where we see that. And I think that will increase both the volume and the maturity of the whole ecosystem to have both sides, because right now we only have the upside of people betting on price increase variation.
Yeah, I mean, I think it's worth pointing out though as well that we are paying them to do that, right? You know, so like it's not like they're doing
Okay.
it out of their own. You know, so this is for me the most interesting thing that's going on at the moment, right? Is there's this like renaissance of token design, right? And for a long time, like tokens were just considered the worst possible thing that you could do, right? If you had a token, you were just a piece of shit and everyone hated you, and you know you're a scammer, and like I think that the pendulum swung too far in that direction, right? Like there were all of these projects that, you know, did ICOs, right? And 95% of them were nonsensical, or, you know, like just never got any traction or what have you, right? I think a lot of people got burned by that. And I mean, even Synthetix, the token design initially was terrible, right? Like we had to significantly change the token design for it to even be usable, right? Because we did a lot of dumb things that everyone was doing, and it was like, well, everyone's doing this thing, and you know, you have these weird convergence of like, we're all just going to run off this cliff, right? And so everyone did, and then we were like falling, and we're like, wait a second, this is like dumb. We need to actually do something to fix this, right? And so I think that
for clarity, for the audience, you are talking about the Aave project, which was the
correct. Yeah. Haven. Yeah. Sorry. Yeah. So, you know, we had this token, the Haven token. It was a fixed token supply, like scarcity token or whatever, right? And it was just dumb in like a whole bunch of different ways, right? And so, you know, we looked at it and we said, okay, what are we actually trying to achieve? What are the lessons that we've really learned, right? From things like Bitcoin, from, you know, layer ones that like fund participation. And we started funding participation for people who actually did something. You get paid in tokens. And I think we're now seeing, you know, a bunch of projects, right? Some projects that came out, you know, from scratch and didn't have to do the dumb things initially, right? Like UMA, you know, they were able to kind of, you know, avoid some of that stuff. And then I think some older projects like, you know, Lend, obviously, you know, looking at their token design and saying, what are some improvements we can make? And so we've got this like resurgence of, let's actually, you know, build these systems so that they are proper coordination games that are like enforcing the rules, that are incentivizing the right behavior and doing all this stuff. And I think that that is going to be, in my mind, one of the biggest things in DeFi, because all of the DeFi tokens are going through this process, and the, you know, the shitty payment tokens and layer one tokens or whatever for like non-existent chains are all still languishing around doing nothing. And I think people are starting to take notice of that, right? And so we've seen this attention kind of shift towards DeFi. And I think it's partially because of that, but I think it's also the token design aspect. So I'm very excited to see the fact that, yes, you know, we are paying people, we are incentivizing people to go and do this behavior, but that is kind of the point, right? Like, so on one hand, they're not doing it of their own volition, they are being paid to do it. But on the other hand, the protocol is paying them to do the thing that we want them to do, and they're doing it, which is a much better place than we were 2 years ago.
And I have to say it works. Like the token model for XNX with the incentivization of over collateralization worked on the long run, and the Synthetix network project was one of the first one to actually build composability with other protocol when you incentivize the ETH and Synthetix ETH liquidity provider on Uniswap, and more recently the SUSD liquidity providing on Curve, which is a cool other protocol of automated market makers. And what we end up with is that SETH and ETH are very liquid, and the price of SETH is very stable, and SUSD is very exactly the same, very liquid and very easy to swap with the other assets. And SUSD had some trouble in the first few moments of its life, but right now it's one of the most stable assets.
Yeah, I mean, trouble's generous. I appreciate that. I think some people would say worse than trouble, but yeah.
What I'll pile on with what Kane is like playing, what Synthetix is pushing and really leading on is this idea of incentivizing behavior with their token, and we're seeing a lot of it now with balancers, BAL token, incentivizing people providing liquidity to BAL. Compound just like out today or whatever, starting to trade today, I think. And it's the part that I think, again, as a DeFi nerd or economic nerd, one thing that is so cool to see is that people do respond to economic incentives. Like they will do the thing that you're paying them to do. And I think that is like awesome to just know and realize and to validate in the real world. The parts to sort of like add a note of caution, or rather the thing that I'm beginning to get maybe a little bit freaked out about, is if people are responding to economic incentives, what if these economic incentives are, short term in nature? And, what if, does it actually mean that a lot of whatever you're paying people to do, it's very fickle, and they'll turn around or stop doing it if you stop paying them, or if somebody starts paying them more. And I think it's interesting to think of like AMMs, like, okay, Balancer pays BAL tokens, does a lot of liquidity go to Balancer until Uniswap starts doing the same thing, and then like what happens here? And in Synthetix, I think there are really interesting sort of long-term cases to think about, where if there is like a long run, like can you get to a long run equilibrium that works? And again, what I'll say hats off to Kane and team for is they're definitely running the experiment to see what happens.
And we don't know the answer. It's an experiment that's ongoing, right? Like, the experiment is going to play out over multiple years, right? Like we still have very high inflation. So, so long as there's high inflation, you are going to have these distorted incentives, let's call it, right? Where it's not self-sustaining yet. Right. And so the idea is like bootstrapping it to a point where it works. And I agree, as someone who's a bit of a yield chaser myself, right? Like I've got stuff in Compound to like farm comp, and then, we're in Balancer, like we're very tapped into like what's going on with this space. But I do think when you look at something like Compound, for example, right? And I was just explaining this to my team because, like I've been in Compound for a while, and I was like, so I pay, 1.5% to borrow DAI in Compound, right? And I'm suddenly going to be making 7% to borrow DAI. Like, what does that do to the overall market, right? Like, I'm a person who genuinely is happy to pay 1.5% to borrow DAI, and now all of a sudden there's all these people that are happy to pay something much higher, right? Because they're being paid in comp to do it, and distorting those incentives could create problems. But I think the intent behind this, and where I'm optimistic about it, is that if you build a much bigger pool, right? If you suck in a bunch more assets, right? And the big one that I see is like Bitcoin, right? I think that once the Bitcoin maximalists get over their like just idiocy, right, about like nothing's real except for Bitcoin, they'll realize that actually there's things that are a lot more real in some senses, right? Like you can actually do stuff with your Bitcoin, and you can put it into Compound, and you can earn tokens, and incentives are there. And I think that that's like the biggest pool of funds that are going to get sucked into DeFi over the next like 12 to 18 months is Bitcoin. And I think you will see Bitcoin flow into Compound, as Wrap Bitcoin or REN or TBTC or whatever, right? And all of a sudden you're going to have a huge pool of assets that are borrowable, right? And therefore you can bootstrap the borrowing side, right? Like you've got all these lenders flood in to farm this thing, and then borrowers come in and go, well, I can get pretty low interest rates to borrow Bitcoin. That massive, like there's whole OTC desks and centralized services that like extract a lot of value out of the ecosystem by being intermediaries for like Bitcoin borrowing, right? Because there's no fucking way to do it permissionlessly, which is its own like head, brain exploding thing, right? Like you can't borrow Bitcoin permissionlessly because it doesn't fucking work as a a platform. So you have to have intermediaries that sit there and just extract massive amounts of fees, from providing the service. If all of a sudden that disappears and is replaced by this permissionless system, that's incredible, right? And when you look at what the impact of that might be on Ethereum, I think it's hugely underestimated by everyone, even Ethereum people, right? Like I think the flow of Bitcoin and the tens of billions of dollars is going to flow into Ethereum through tokenized Bitcoin that then is accessible and can be lent and borrowed and traded is going to be massive. It's going to be a huge, huge groundswell. So for me, that's like the biggest thing over the next 12 months that I'm hoping to see.
I also agree. Bitcoin maximalists hate it when I say that, but I do believe that the future usage of Bitcoin will happen on Ethereum, and I'm ready to bet on that as well.
You got to give us a market, right? Like, what percentage of Bitcoin will be on Ethereum?
Well, it depends how you put it on Ethereum too. That's the other thing. Like, how do you lock it up and collateralize it? Like, okay, just to end with, or to talk more about the pure synthetic version of Bitcoin, like you could create Bitcoin or an asset that tracks Bitcoin without using Bitcoin, just by creating a synthetic asset collateralized by Ethereum or SNX or whatever else.
Yeah.
Why do people have a mental block on that of these things not being equivalent? Synthetic Bitcoin on Ethereum, not backed by any actual Bitcoin versus real Bitcoin. Well, I guess you'd argue they don't believe the mechanism of synthetic Bitcoin on Ethereum yet. They don't, But that should change over time, or hopefully changes over time. And then there's like, again, this Kane, your earlier point of like we can nerd out over all the mechanisms, but I do think the broader thesis of like Matt Longo says this very well, right? Like you marry the two sides and the market is much, much bigger. Like, I do think that thesis is like a very reasonable idea, that you got to bring utility to Bitcoin, bring the store of value utility that Bitcoin has, bring that to Ethereum. That would be a very good outcome for us all.
Yeah, and I agree with you, right? Like there's totally synthetic versions of things, right? But there's a reason why there's this like spectrum of I'm happy with paper gold because I trust my counterparty has the real gold versus like, I don't trust them and it's just like a CFD or something like that. Like there's this spectrum of like realness of gold versus like the guy who literally has a pit that he's dug in his backyard and it's full of gold, right? And it's like, unless I can like lick it and touch it, like it's not real, right? And so I think that when people are kind of like, well, I'm happy to put my Bitcoin on Ethereum, but like I want it to be real Bitcoin somehow. Like even me, 6 years later, I still have that sense of like, I like when I put like Ren BTC, like, and my BTC gets locked up, and like I still feel like a sense that it's real BTC. But like I've got a lot of SBTC, but I've got Ren BTC, and the feel of that, it's like it's closer to me of like the pit of gold in my backyard than like just trading like paper gold, right? And so I think that there is a range, and I think there's uses for each of them.
That is actually really interesting that you, in your own, like knowing how this all works very deeply, still feel that. I think that's
I do. Like it's still like horny, like but I want to hold on to it, right? Like so, I do. But something that I said to someone the other day is like, I've been holding Bitcoin. I think I did my first Bitcoin transaction like 6 years ago, right? In that entire time, I tried to kind of do like a bit of analysis. If I've done 50 on-chain Bitcoin transactions, I would be surprised. Like 99% of my activity with Bitcoin has been like on, Polo or Kraken or something like that, right? I regularly do 50 Ethereum transactions in a day, like regularly. Like, so when you think about, there's this like untapped gold mine of like Bitcoin just sitting there, right? And not being used, right? Maybe it's being used to be traded on like centralized exchanges. I think it's going to be just mind blowing when that actually shifts over and people realize that they can take their Bitcoin, they can have it, and it, they're comfortable with the control that they have over it, and it can be on Ethereum and do stuff. I think Bitcoin maxis are going to be blown away when that is a thing, right? So, and it's coming, it's really close.
And
yeah, I mean, that
go for it. Sorry, go.
No, sorry. All I was going to say is, like, just from a financial engineering perspective, it is quite amazing to think that you have this Bitcoin collateral, like, you know, a couple $100 billion of it sitting there doing absolutely nothing. Because I too fully agree with you, Kane. Like I have, from my Bitcoin, I actually have, like, I really am a true hodler. I've never sold it. I've done so few transactions with it. It just sits there. Yeah. But Ethereum, back and forth, all this stuff. And because there's utility, it highlights, like, there's utility, there's things we can do with Ethereum, but there is no utility other than it just sitting there for Bitcoin. And so the inefficiency of that is sort of shocking. And that will change.
Yeah, agreed.
I completely agree. And if you think about it, if you provide liquidity on BlockFi, which is a centralized service, and it's a good service, and they are like serious about it, and providing liquidity on Curve on RenBTC or WBTC, what do you prefer if you believe on decentralization? Like, to me, it makes no sense that the Bitcoin community will stick to centralized service.
I mean, I think, you know, there's this cognitive dissonance, right, for Bitcoin people, where, like, I can only do things on centralized services, right? So, like, you just park that away and you just, it's like this, you know, bad family secret or whatever, like, that you just try to not address, right? Like, you know that you can only do things with it on a centralized platform, but really it's like all about hodling and just like holding it, you know, somewhere secure. And I think that will break down, because it's not sustainable. Like, it's not sustainable to hold those two views in your head, where, like, it's this amazing thing with all these security properties, but also you can only ever do anything by handing that security over to someone else and giving custody to someone. I think that cognitive dissonance will evaporate at some point, but we just need to get them over the line, you know, 4 years later, that, like, the you know, DAO hard fork wasn't the end of the world, and it's all okay, right? Like, we're all still here, it's fine, right? Like, just relax, guys. So anyway, we'll see.
One of the last topic I wanted to talk about with you guys is that it seems that MakerDAO is willing to join the party of the synthetic assets. What do you think of this new actor that will be at the same time a minter of a stablecoin, which is the DAI, and also using a minter of synthetic assets?
I mean, like, Rune has been talking about this for a very long time, right? Like, it seems like there was a period where they were so focused on MCD that it was like, no, don't talk to us about synthetic assets. Like, I remember seeing Rune in like, I don't know, Berlin or something like that, in like early 2018, talking about the synthetic assets. And I think it's just taken them a long time to get there, but we've always known that Maker would have synthetic assets and it would be a competitor to us. It would be a different, you know, approach to the problem. But I also think, you know, we say competitors, right? But, like, it's a bit laughable, right? Like, even within crypto, like, okay, yeah, like, UMA is a competitor of Synthetix, and, you know, there's Strike Protocol, and there's, like, you know, Vega, and there's a few other, like, people out there, like Market Protocol, that are, like, doing synthetic assets. DYDX, you know, has derivatives and stuff, and all of us put together are, like, could fit on, like, the head of a pin, right? Like, compared to even BitMEX, right? So, you know, there's this huge untapped, centralized, terribly operated, like, you know, very customer unfriendly system out here, which we all want to kind of pull into this open, transparent, you know, ecosystem, right? And so all of us together, even if we only get a small fraction of that, I think are going to be, you know, have orders of magnitude more traction than we have today. And so I think this idea of, like, you know, we're competing with Maker, UMA's competing with Maker, like, it's a bit fanciful right now. Like, no one's competing with anyone, realistically. All of us collectively within DeFi, I think, should be trying to optimize to, like, to educate and bring these people that are all operating on centralized platforms, to bring them into DeFi and explain to them why that is a much better thing for them than what they're doing now, what the status quo is. That's my, like, genuine view. So I welcome Maker doing it, because Maker does an amazing job of almost everything they do. And I think when they do it, they're going to assist everyone else who's in the space to kind of normalize it and get people excited about it.
Yeah, and I'll just agree with that. Like, Kane, I know the video you're talking about with Rune at like DevCon 3 talking about creating synthetic assets. They've been talking about this for a long time. We are incredibly close with the Maker team because they're great and they do great work and all that stuff. So it's just, there's no, I don't even, they're going to have a different approach and all that. And, there's an earlier question you asked, Mark, too, where it's like, if some stable coins like DAI are synthetic assets, and they very much are. It is like a very similar concept or infrastructure. The way I actually would look at DAI is in DAI I own ETH collateral, but I'm short ETH versus dollars. So I do the math and I end up having something that's supposed to be stable worth $1, right? It's very similar to a lot of the stuff we're doing. And again, it's all builds off each other. It's great. So they are very much going to stay focused for a long time on doing the stablecoin thing and doing it right. And the idea of a permissionless stablecoin is like so huge and so important that they should, spend a lot of energy on that. And to the extent they can help develop the rest of the DeFi ecosystem and develop people's thinking and understanding of how synthetic assets should work, that's welcome.
I think that's a great word for the end. But do you both have something to announce on your project, something on the roadmap that you want to share to the audience before we close the call? Art?
We're trying to do a lot of, we're trying to be very public now that we're a live token project, very public with what we're doing. We will be distributing tokens to our community, like, again, another type of balancer or compound like distribution of our tokens to incentivize usage. And we're actually trying to designing that program in public. So if anybody's curious about that, you can join our Discord, or there's some Google Docs flying around and different conversations about how that program should work. So maybe I'll push people that way. If you're interested in earning UMA tokens by using the product and services, come join our Discord.
It's becoming more and more of an industry standard. I think people call that in the community liquidity mining.
Yep. That's so we love this idea for the same reasons Kane articulated. It makes sense. Like, we want to. It makes all the sense in the world to. Or rather, you even step back. How cool is the idea that you can actually give early users of your product something of value that hopefully goes up in value as your product succeeds? Like, that is a wildly cool kind of idea that is fun to play with. And I think it should be a standard, because I think it's one of those things that token projects can do that other startups or businesses really can't.
What I think really interesting about that is that liquidity mining can replace completely the ICO process, because basically you try to, as a project, you initially try to raise money in order to get some critical mass in order to develop new markets and grow in that way. But with liquidity mining, you are doing your ICO and your project live directly, and the incentives are completely aligned because the asset is at the center of your project.
I think I agree with that to an extent. I do also think there's still some things that need to be resolved there, right? Like, I talk to a lot of early projects, right, that are like still in like the seed round phase, and I advocate very heavily for, there's a lot of dumb things that we did that we're slowly shifting away from, but there's a lot of dumb things that we did that we're still doing. Foundations in Switzerland, I think, are a dumb thing that people shouldn't do, and so I think that we now are getting to a point where, like, you combine the idea of liquidity mining or something like that with from the beginning decentralized governance process that's run by a DAO. And I think if you can combine those things well, rather than going out and raising equity into like a private entity that's domiciled somewhere. I think you can build something that is like decentralized first or DAO first. And I haven't yet seen anyone kind of pull that off. There's a few people that are like looking at it. Pi DAO's maybe like the closest. But you know, I think there'll be a project that kind of comes out that like gets all of these things right, you know, that like gets the Genesis part right, gets the liquidity mining part right. And I think it's going to blow up and people are going to be like, oh, it's so obvious now. But we still don't have a great example, I think, from the beginning, because, you know, Aave's been around for a long time. Like we've been around for a long time. You know, even UMA's been around for a long time, right? Like in the DeFi scheme of things. And, you know, there's just vestigial stuff that was done that we did that I think, you know, hopefully the next set of projects that come out will kind of throw away some of these bad approaches and fix them. And if you can get all of that right, I think it's going to be really cool.
Yeah, I really think we should all remind ourselves that we are building things that were not existing before. And obviously there's a part of experimentation around that. And what I can see is that we have a clear difference in 2020 between what is currently live on mainnet and what was the model in 2017. And I think it's mostly for the better now. And but it's still a process, as you say. We are still learning and we are still building, and we will see new things happen in the future.
Agreed.
Well, we are
100%.
We are 15 minutes over time, so let's let's finish.
I was trying to like push you guys through to like midnight or something your time, so that I could like equalize, right? Like I'll get into my day and you guys start to fade, and I could reel you in. But anyway, I guess we'll end it there.
Thank you very much for your time, both. That was a great experience.
Marc, this is great. Marc. Thank you so much.
It was really fun. Thanks, Hart. See ya.
Yeah, Kane, talk